Good afternoon, everyone. Scott Sturgeon here. I'm with the Practice Management Group. For those of you I have not had the pleasure of meeting or speaking with, welcome. Thank you for taking the time before this holiday week to sit in on what I hope will be kind of a relatively brief but really informative meeting on the insurance group generally, and then specifically we're going to get into income protection as kind of a backstory on what we're going through kind of with this series. I know I sent out a lot of invites or calendar invites. I learned the lesson not to send it from my personal email. I got the pleasure of getting 75 acceptances, which was a positive overall, but quickly filled up my inbox. But regardless, I think the goal for today and really for this series is to talk through insurance generally. I think often we learn about it, we hear about it, maybe we're working with clients on specific issues, interacting with the insurance group for that, or we're getting it from what I would kind of classify or quantify as a academic perspective, i.e. if we're learning through CFP curriculum or things like that. And so sometimes I think it's just helpful to kind of hear it talked about in a way that maybe you're not getting from a lot of the typical channels that you might be. And so really that's kind of our goal. We want this to be informative and relatively casual. It's going to be pretty conversational as we go along. But if you have questions, by all means, there's a chat box within Ring Central. I really encourage you to ask questions. I'm happy to read those off, and we can go through them as they come in. So don't be shy. Just to start, here in the room with me, I have obviously myself, then George Fernandez, also with the Practice Management Group.
Hey, everyone.
And then Ed Sims and Jerry Clark, both with the insurance team here at headquarters. Thank you guys for taking the time to sit down with us.
Welcome. Look forward
Thank
to
you.
it.
Yeah, should be informative. So just to start, I think we've got many people on the call, many of whom I'm sure have worked with you in the past. Maybe some of whom are hearing your names for the first time. Could you guys maybe just give like a brief intro for the two of you, or maybe a little background on yourselves?
Sure. I'm Ed Sims. I founded the insurance group back in 2009, Mariner Insurance Resources, as one of the first advisory solutions groups to Mariner Wealth Advisors. The goal again of Mariner Insurance Resources is to be a resource for the advisors to be able to help you and your clients, with any kind of insurance-related issue, and not just life insurance, but some other types of insurance, and limited to some other types of insurance as well. But again, we're not here to represent any companies, no organizations like that. We're all about creating a fiduciary standard in terms of the advice that we give clients, and help you understand how insurance plays a role in their plan. So that's just kind of a quick background on the origin of insurance resources. And I started out in the insurance business clear back in '93, and been with a few different companies. And then I'll have Jerry give his intro.
Thank you, Ed. So Ed and I actually go back to 2000 in a former life. We were both at Hartford. My stamp on date, if you will, in the industry dates back to 1986. Like most, I started out on the retail side. 94, I made a move to the wholesale side, which is more the expert role. I took a position with Hartford Life, had a really good run there. 2000, Ed joined the team. We took our operation to the #1 category in all of Hartford. So we know what it's like to work with the hyper high net worth clientele, the visions, values, and goals that the clients have. It's been a very, very good industry, very good business to be in. Ed, in '08, I guess the wheels fell off the wagon at Hartford, and so Ed joined Mariner over here, and I kind of took a different path. And here recently, I've joined back with Ed. This time, I'm going to be the employee and not the senior partner. You're in good hands here. I know that the Bicknell family dates way back to 94, I guess, with the work I've done for their family. It's a great organization, and look forward to helping you all.
Awesome. Thanks for taking the time to kind of walk through that. If you just to kind of start, and either one of you can field this, if you had to boil down at the very essential level what it is the insurance group does, and maybe just, your elevator speech, or at the simplest level, what is it that you guys do?
Well, this is Ed. In my opinion, what we do is to make the advisor feel confident in any type of insurance situation or anything that has to do with an insurance license. We have the capability to make the advisor feel confident and trust whatever the need, whatever the solution is, whatever the circumstances are. We can help you in any life insurance situation, annuity situation, long-term care situation, anything. It's just the advisors need to know that we're here for them.
That was 37 seconds. Thank you, Ed. Perfect. Jerry, anything to add?
On a simpler note, I'd just say today's discussion is going to ultimately hone in on income replacement. So in that vein, I'll say my elevator speech is we're the self-completion clause that clients have, meaning that your clients are working with you on a daily basis or weekly or monthly, whatever basis. You're mapping out a great financial plan, but in the module today, what happens if they just don't wake up one day, or they get disabled? Who's going to complete the plan? Who's going to make sure that everything gets funded so everybody has a happy retirement, educations get paid for, houses get paid off, and things of that nature? So on a very simplistic basis, we are your self-completion clause.
Nice. Yeah, I think that makes sense.
Yeah.
I
like that.
Oh, anything, George?
Yeah, actually, I like how you describe that, because I think we often kind of wonder, how do we begin, or how do we start having these conversations with our clients. I think we all recognize it's important, but sometimes we shy away from it. And I think that's a really great way to describe what ifs that we encounter.
Nice. So I think one of the central kind of points to make, and I mentioned it earlier, this is part one of a series that we're hoping to do. Would one of you I think it was a really interesting topic. We met maybe a month ago to kind of talk through what these would be like, and you guys have done a really nice job of making it very concise on kind of the 6 buckets of insurance or risk mitigation or protection planning that you all deal with on a regular basis. And do you want to maybe just kind of touch on each one of those and kind of what they're about, and then we can kind of delve into specifically the income piece that we're here for today?
Sure. So the first topic is obviously income protection, which is by far the most basic, the most crucial to a lot of people's plans. So income protection, and we'll dive into the details on how that works. But that's actually the top reason that people buy life insurance is for income protection. But anyway, income protection, asset protection, and asset protection from the perspective of protecting assets in the case of a extended care situation. Okay. Also, longevity protection. Longevity protection is where we can shift the risk of running out of money we can insure that risk through the use of annuities and so forth. Then we also have wealth legacy planning, where we design plans so that we can transfer wealth to the next generation on a very, very effective risk-adjusted basis and a very effective tax-effective basis as well. And then the other topic we'll talk about is business planning, and where the opportunities are there and where the gaps are, and how we can help your clients, help your business owner clients. And the last one is the accumulation and distribution planning as it relates to using insurance, and why we use life insurance in certain situations for that.
I think that's helpful to kind of, regardless, it's kind of product or whatever agnostic. It's basically very topical. I think that's a nice way to think about it. Kind of
right.
Break it down. Jerry, anything to add or thoughts?
Yeah, not so much about the 6 buckets, if you will, but more in terms of the distribution of these modules. I made an educated decision in 1994 to quit marketing insurance solutions through insurance people. And I came to that realization because I don't like the way the insurance industry distributes product. It's like when all you have is a hammer, everything looks like a nail, and at the end of the conversation, you're going to own a life insurance policy because, by golly, it cures cancer if you listen to an insurance agent long enough. I mean, it's crazy, some of the things that they say about life insurance products and disability insurance. So we're in a unique position here as a fiduciary to distribute these modules to the clients in a very non-threatening, non-invasive way, where the client feels like they purchased something at the end of the day and they're not sold something. So my comment's more along the lines of just how we market this.
Yeah, that's a good distinction. Being the purchase versus sell is a nice comparison. It's like, it's the knowledge, knowing that whatever that they are purchasing is tailored to them. It's not necessarily just something that just so happens to have a outstanding commission on the back end or whatever the case may be.
Or a trip to Tahiti or something like that.
Yeah.
How my stars that.
All expenses paid. Yeah.
I call it the ugly ingredients how sausage is made in the industry. The way they distribute product in our industry just makes my blood boil. And I see it on a daily basis. I mean, some of the annuities we review, you just sit there and you scratch your head and kind of go, God, is this all these people do is sell annuities day in, day out.
Mm-hmm. Yeah. Yeah.
But I would say 80 to 90% of the things we do are educating advisors, educating clients on what they have and maybe what they could use as an alternative that maybe make their position better.
Yeah.
But it's really an educational process versus a sales machine.
Yeah, it seems very consultative. I think, Jerry, we had a call this earlier this week, and you kind of mentioned as being essentially pro bono work that you guys do, but there's obviously inherent value to that. The ability for advisors to approach clients and more readily discuss, the insurance topics of mind for them.
Yeah. And I think that can't be understated at all, because the fact that when you're going out there, you're meeting with the clients or you're meeting with the advisor and the client together, you're on the same side of the table as the advisor and as that fiduciary, and looking at this from that perspective. We can talk all day long about whether insurance sales are considered fiduciary transactions. That's a whole nother conversation. But this is the way in which we behave. This is the way in which we interact with our clients. We put them first. And that education is a really important piece. Just because they go out there and they have an insurance policy, our immediate thought is not going to go out and just replace it. It's going to be, is it the right thing to have? Right? And why do you have it? So I think asking those questions, it's a really great point.
Yeah, it's the insurance industry's job to make these products very complicated. It's our job to simplify them and translate into the clients and advisors to an easy, understandable solution.
Yes. Perfect segue. In terms of simplification, we've got our 6 buckets. Each one has a very certain role. So obviously for this session, we're kind of talking about income protection. Do you guys want to delve into really what that means, kind of at a very basic level, and then kind of an overview from there?
Sure. So I'm going to touch on the life insurance portion of it. So we can break this down into the life insurance portion of it and the disability income portion of it, because at the end of the day, that's what we're doing, is we're protecting income. And there's only 3 options. You're either working if you need to work, you're disabled, or you're dead. So those are really your 3 options.
It's really uplifting, I think.
Yeah. Here in Thanksgiving.
I'm thankful for being alive. That's a good start.
So at the end of the day, we want to make sure that all of our clients, in whatever situation they're in, if we know that if the breadwinner or if anybody in the family that people depend on don't wake up, that there is some way to offset the loss of income or the added expense that will bring. And that's really what it boils down to. So if you have any clients that you advise, and if any of them didn't wake up tomorrow, and it would put their family or their dependents in a worse situation than they are, then you have an obligation to talk to them about replacing or making sure they have the proper income protection plan in place. So as it relates to the life insurance part of it, one of the biggest questions I always get is, how much is enough insurance? You know, you know, there are calculators for life insurance planning. There's probably 100 of them on the internet. You can find them, and you can plug your information in all of them and get a different answer back every time. What I like to do is keep things as simple as possible, and in doing that, one of the strategies that I like to use, or the way I like to be able to explain it to clients so that they can understand how much insurance they need, is I've got a little simple formula. And the simple formula is like this: whatever income is needed by the dependents or survivors, you need to take that times 20. That gets you to a lump sum amount that you can take 5% off a year. That lump sum amount is not the amount of life insurance you need. That's just the amount of capital that's needed if you don't wake up. Okay? That can be offset by your savings, other insurance, group insurance, those type of things. So if you, as an example, let's say you have a client that makes $250,000 a year, and we know that there needs to be $5 million of a lump sum, and they've got $1 million in savings, and they've got $500,000 of employer-provided insurance, and they've already got $2 million of term insurance. We're up to $2.5 million that we've already offset that $5 million gap. Okay, so well, with the $1 million savings, we're up at $3.5 million. So you got the $1.5 million of savings, $2 million of term insurance, $500,000 of group insurance. You're up to $3.5 million that you've got covered already. So the gap for this client would be $1.5 million.
So for those of you listening, I've put that up on the screen for you to view. I'm failing as an MC today. I apologize for that. But everything Ed just talked through is on the screen now. You can see all the numbers there. But I think that makes a lot of sense. 20 kind of being the magic number, the key to remember.
Yeah, and the 20 times the income gets a 5% value, and then we back out what, basically our self-insurance or other insurance that we already have taken care of. So if this guy doesn't wake up, there's $5 million to recreate that income for their survivors and dependents. So very, very simple. There's different ways to do this. The most cost-effective, the most simple way to do it is term life insurance. There's a lot of other kinds of life insurance. There's permanent insurance, but for purposes of this discussion, we're just focusing on term insurance. This solution would have a premium of around $2,000. So that's the challenge I give to all of you, is find the gap. Find the gap that your clients have, and let's get that gap filled so that the families can always sleep at night knowing that no matter what happens, we've got them taken care of from an income protection perspective on the life insurance side.
Gotcha.
So if you put that in perspective, I'm just thinking out loud here, Ed. If I had $1,500,000 home and someone came along, I would buy homeowners insurance, obviously, right? So if the premium was $2,000, that'd probably be a pretty good price tag for a homeowner's policy every year.
Absolutely, yeah.
And this particular homeowner's income protection is guaranteed for 15 years level?
Yeah.
In this situation? Okay.
Yeah, the sad thing is most people spend more on their car and home insurance than they do their life insurance protection. And what's more important?
Yeah. I guess it's you say, it's a tangible thing. I walk into my home, I can drive my car, but my life insurance policy kind of just exists in the ether until I need it.
Absolutely.
Interesting. Okay. I think that makes perfect sense. My thought, as in terms of not even just a demographic, but just like age-wise, in this scenario, we have a 50-year-old male, it could be female, it doesn't really matter for that purpose, but we're keyed in on income replacement, i.e., if they're retired, a term policy, maybe you'll be a fit, maybe not, probably not.
For income replacement in a retirement scenario, that's when we would just focus on like pension, if the pension goes away or Social Security goes away or anything like that.
Okay.
That's not as important as income protection in our accumulation years, our pre-retirement years, because in a lot of situations, clients will become self-insured. That's our goal with our clients, is to have them be self-insured from an income protection perspective.
Okay. So self-insured, they have accumulated a significant enough amount of assets.
$5 million in savings, yeah, self-insured.
To cover any costs.
Yeah, so if you go through and do the math on this table that you have here, and it comes up as 0, then it's that you're self-insured.
Yeah, you don't have a gap.
You're covered.
Yep.
There's no gap in that case. Yep. Can you speak to a minute and just see this example here? You have you have the term policy premium there, $1,800. You've got a 15-year term, I think you said on this example. So can you kind of speak to that just a little bit? Because there's different kinds of term policies, right? There's annual renewable terms, there's 5-year, 10-year, whatever, 20 or 30, whatever. Can you speak to that just a little bit?
Right. So term insurance it's really classified into level premium period categories. And so there's annual renewable term, which is not a level premium. The premium increases every year. It's rarely used. We only use it in certain situations, but it's pretty rare. And then the next classification is a 10-year term policy, which the premiums are guaranteed not to change for 10 years. So a level premium for the whole 10-year period. Then there's a 15-year period. Again, guaranteed premiums for 15 years. There's a 20-year, 25, 30-year, and some carriers actually have dial a term now, where you can dial the term to the exact year you want it to. Like if you want a 27-year term policy, you can get that and have the premiums be completely level for that whole period. One thing that people don't realize with term insurance is that with most carriers we work with, they allow us to reduce the death benefit if we need to in the future. So as somebody's savings, grows and we see the gap gets less and less every year or every few years, we can modify a term insurance policy to reduce it. Can't always modify it to increase it. We'd have to go through underwriting, but as it relates to term insurance, we can reduce it. Also, I want to say about term insurance is the industry is coming to a point where like the exams, the bodily fluids, the poking and prodding, everything like that is going to be history eventually on certain situations. So if you have certain clients that are in really, really good health, all they need to do is a quick little phone interview, and they'll be approved in like 24 hours or less. They're using a lot of data analytics and everything like that to do underwriting now. So for your super healthy clients, they don't even need to have an insurance exam, or as I refer to it as a free physical. Mm-hmm. So anyway,
as Jerry smiles.
Yeah, right.
We're living in the future.
Yeah. I saw on TV the other day, they're talking about these smartwatches and the amount of data that they're collecting, and the privacy laws. That's a whole rabbit hole I don't want to go down, but that's going to have a play. I can see right now where the insurance industry is going to want that data.
Yeah, in fact, John Hancock right now has life insurance policies that you can get a discount on if you wear a Fitbit, if you go to the doctor and do this test and that test and the dentist and blah, 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 blah. You can get up to a 20% discount on your life insurance premium if you want to jump through those hoops.
Kind of like a vitality program.
That's exactly what it is.
For life insurance.
Right.
We have vitality programs often with in our employer plans. So.
It's right. Exactly what it is. Vitality with John Hancock.
Yeah, interesting.
Nice. One question I have, let's say we have a client who's acknowledged the need for this kind of solution, kind of an income protection plan, so to speak. As they get to a certain point in their lives, they get towards that kind of question of, I've got this policy. Maybe the term's ending, maybe the premiums are going to jump, or maybe it's not really as necessary. I think maybe we'll get into it more in some of our other, bucket discussions. But is there kind of an approach that you guys have for maybe at a minimum having that conversation, or are there kinds of solutions you implement for those types of clients, kind of maybe aging, quote unquote, aging out of whatever solution they might currently have?
Yeah, that's pretty common. We get to the retirement years and people have term insurance policies, and they're always asking the advisor, well, what should I do with this policy? And And, you know, a lot of times the advisor just says, okay, well, you don't really need life insurance anymore, so just let it lapse, whatever. But, you know, there's some of those situations where, you know, it can make sense to continue it on, to have it be, you know, a permanent part of their plan, either to replace assets. You know, there's a lot of different reasons for it. I don't want to get into all of them right now, but in a lot of situations, term policies have convertibility privileges, and I'll just throw one out right now. We just converted one for a guy that didn't want his insurance. We sold it for him on the secondary market. So just to let a term policy lapse just because they don't think they need the coverage isn't always in their best interest. So
interesting. That was an interesting situation because this guy literally had term insurance and he had a medical condition, cancer, right? And he's like, I'm going to just lapse this term insurance. And Ed got brought into the mix, and he's like, no, I think I've got a market here where we could actually like convert this to an insurance, you know, a permanent plan, and then I can take it to the auction market. What did the guy end up walking away with?
$45,000.
He paid term insurance premium, use it, lose it, term premiums. He walks away with $45,000 minus, you know, our fee that we had to bake in the cake. But there was a top line of $45,000 on a term sale, in essence.
I'm just envisioning Ed busting through the door. Don't you dare let that policy lapse.
Yeah. That's a really great point because he probably recouped most, if not all, of his premiums over the years that he had that.
Yeah.
That's very interesting. Yeah. So don't just immediately go in and say we're done with it and let it go.
Yep.
That's really
in fact, that might be a
lesson there.
That might be a 7th module.
Arbitraging term insurance.
Yeah. We're making them up as we go here. It's great. I like the synergy.
So can you speak to, you know, we just touched a little bit on the conversion, but you converted it to something. What did you convert it to?
Well, with this company, there was only one choice to convert it. So they had a conversion product that they had to convert it to, and it was a permanent universal life policy with guaranteed premiums, and it was it's a plan that basically has level premiums for the rest of his life.
Okay. So in 30 seconds or less, I'm just kidding. Can you give us maybe just a high-level description? There's different kinds of perm policies. There's the universal life policy you just described. There's variable universal life policies. There's variable whole life policies, and there's whole life policies. I think they're probably the four most common. And I probably missed another one in there possibly. But can you give a high-level view of kind of what those?
So as it relates to permanent policies, permanent policies, I'll just kind of go from the beginning of time to now. So we first started out with whole life, and whole life policies were designed to pay a premium for your whole life. And whole life, let's just call it age 100. So it's basically a sinking fund to fund the death benefit. So if it's $1 million policy, the premium is supposed to be able to fund that $1 million over your lifetime. And they discount it and everything like that. So it's the cash value is left with the insurance company. It's you're a general accredited insurance company. You get credited based on the insurance company's dividend scale or general account. But anyway, in a whole life policy, premiums are guaranteed, death benefits are guaranteed, and cash values are guaranteed. So you got 3 components of guarantees. You pay a lot for it, but that's what you get. Now, with whole life policies, you get term riders, and I'm not going to get into all that stuff. But the message is whole life offers guarantees across the board. So then the next category of permanent policies is the universal life policies. So universal life policies started out with E.F. Hutton back in the late 70s, and otherwise known as money market life. This was when there was an inversion in the interest rates, where the short-term rates were higher than long-term rates. And they started basically a life insurance policy where your cash, you could take your money out of your whole life policy, because that was long-term money, and put it in universal life policy, which is short-term money, and you could get a crediting rate on your universal life policy at a rate of 10-12% on your money, because CD rates back then, short-term interest rates were really high. So that started the appeal of just universal life policy. So it's in essence a short-term money market fund as the cash value bucket with term insurance on top of it is essentially what it is. and it's completely flexible in premium. Premiums are not guaranteed on the first versions of universal life. Death benefits were not guaranteed. Cash values were not guaranteed. However, as universal life has evolved, now we have premiums that are guaranteed and death benefits that are guaranteed, but no cash value guarantees. So that's the difference truly in today's universal life. It's referred to as GUL, a guaranteed universal life. Guaranteed premiums, guaranteed death benefits. It's a lot cheaper than whole life because they don't have to guarantee the cash value. So then the next variation of permanent life insurance was variable life insurance. So everybody saw the advantage of using short-term interest vehicles as a powering mechanism of life insurance. The next stage was the variable life, where we could now use separately indexed accounts, or quote mutual funds, to power the cash value growth insurance. Now, what this was, allowed a lot of quote insurance folks out there to start being in the investment business, which was, in my mind, was a bit of a mistake. So there was a lot of abusive sales of quote variable life insurance out there, and the SEC and FINRA allowed it to be illustrated at 12% rate of return. And so there was some very, very abusive sales tactics out there, and that over time those issues kind of came to roost. And Jerry can talk about that in more detail. But then I'll let him talk about variable life here in a second. Then, so after variable life came indexed life. So the third generation, or really the fourth generation of universal life. Now what they're doing is creating segmented index buckets as the crediting mechanism within the life insurance policy. And just a very simple example of that is, let's say somebody's got $100,000 of cash value in their policy. The index is at 5,000, and it's got a cap on it of 10%, and the index goes up to 5,500. Now we've got a 10% interest credit on that cash value, whereas if the index would have went down to 4,500, there would have been no credit on that policy. So you don't lose money as it relates to the downside performance of an indexed product, but you can participate in the upside of an index product. And then the industry as always becomes really abusive on that and creates leveraged buckets and all these backflips and makes it very confusing. There again, so we went from whole life to universal life to guaranteed universal life to variable life to indexed life. And that's really the gamut of permanent life insurance. Now you've got variations of single life and survivor policies. Survivor policies are the policies that insure both, like a husband and wife or a couple, and the death benefit pays on the second death to mirror when the taxes would be due in an estate transfer situation.
I appreciate that. One of the things I think is really important, the big takeaway from this is that you gave a very great, concise rundown of each one of those types of policies, and obviously you can dig very deep into each one of them individually, which is not something we're going to do here. But I think suffice to say, this is something that it's good to know high level what these are, and that's why we have you to dig deep into the weeds, because that's what you guys love to do every day. And he's smiling here when he talks about this, folks. I just want you to know. So this is the stuff that gets them all excited. So let them handle that, because as you just rattled off, that's something that you spend a lot of time working on, and so I appreciate that.
I want to switch gears real quick. We've got like 7 minutes left. Disability insurance. Could you kind of talk briefly to that a little bit? Maybe for whatever age group it's the best fit, or just as it pertains to that kind of income protection approach. Where does that factor in?
I'll tell you what, Scott, let me bite on that one. This is Jerry here. So an honest confession is good for the soul. I'll try to get through this in 7 minutes or less. June 18, 2004, that's 15 years ago. I'm in Hot Springs, Arkansas. I'm a keynote speaker for a convention that's being held down there in the insurance industry. I'm down the road, walking distance from the Arlington Hotel. We're having cocktails. I look at my watch. I tell my guys that, hey, I got to go back to the hotel. I'm speaking to you at 6:30 in the morning. It's 10:30 at night. So I'm in a green light crosswalk, and a girl decides to hit me 45 miles an hour. So I don't know if you've ever played Dodge Car, but I'll spare you all the details. But man on foot versus car, even though it's a low-profile Kia, is very bad Father's Day weekend, to say the least. So I ended up on a stretcher. I ended up in a hospital there in Hot Springs, Arkansas. I didn't realize it, but I had work comp insurance of all things. So I actually participated in all forms of disability insurance through my total and complete 4-month disability. I had short-term disability with my insurance, with Hartford, who I work for. I had long-term disability group coverage with Hartford. I had workers' compensation, and then I had my individual disability insurance. So this is the way it went down. Short-term disability through your employer, pretty simple. You know, they pay it. It's usually 60 to 80% of your wage, and out the door you go. Long-term disability takes about 90 days before it kicks in, some even longer, 180 days. Once again, not necessarily protected in your own occupation, and it can get a little goofy on a really long-term disability. So it's rather inexpensive in premium, but you get what you pay for. Workers' compensation, highly suggest you never get processed as a worker compensation claim, because you find yourself 5 years later in a court of law arguing with Nurse Ratched that you should be getting your check, and it was just an ugly situation. My individual long-term disability paid like a slot machine. So I had own occupation definitions for disability, meaning that there's a lot of things I could have been doing in that chair I was living in for 4 months, but I was protected in my own occupation. I also had guaranteed renewability features and waiver of premium features, and most importantly, I had this thing called residual definitions for disability, or partial definitions for disability. Interesting thing that happened there was I was #1 in all of Hartford when I got hit by this car. I probably was never going to repeat that level of production ever again. It was kind of an anomaly, if you will. But my contract said that if I suffered a disability and my current income did not get within 80% of my pre-disability levels, I'm still entitled to partial claim. And so even though I had a full normal recovery and I was back to work in 4 months, I was getting a check from the insurance company like a slot machine for 2 years, until one day this young man showed up in my office and closed the door and said, "I'm going to write you a check today. You're going to sign a piece of paper, and we're going to be done with this, because we're never going to get off claim with you. It's just contractually impossible." I said, "Okay." So we sat down and we negotiated a confidential number. He gave me a check. It was tax-free. He left. I went to the bank and bought a farm with it. And here I am today, fully recovered, loved it. Highly recommend you protect your income. Disability should be the first conversation you have with upwardly mobile individuals that are making a lot of money.
So there's three components to a disability policy. And I don't mean to get into the weeds on it, but one is the own occupation protection, like Jerry mentioned, and this is an individual plan. The second one is a cost of living adjustment, and the third one is the residual income or partial disability benefit. If you have all three of those on your disability plan, it's gonna work very well for you. And a lot of these disability plans get settled, and these are the plans that bring the most value to a settlement discussion. So I wanted to touch on that. If there's any questions about how disability works, but as you know, as it relates to the calculations and things, I put an example here of finding the gap on that as well on this sheet. So find your disability gap, find your life insurance gap, to make sure your clients have the peace of mind knowing that you've got them taken care of.
Yeah, no, all excellent points. I can't remember who referenced it or who presented the example to me, but it's like, when people think of their assets, they don't necessarily think of their earnings as an asset, but it's really essentially the largest asset you have is your future earnings over time. If you had a machine in your basement that literally printed money all day long, would you maybe think to get a policy to protect that machine in that its ability to continue producing income, i.e. that's you. You go to work every day, over time, you're able to produce more income to that then generates more income and so on and so forth. But, to not have something in place to protect that, I think seems pretty straightforward.
Right. There's a lot of liability in overlooking this conversation. I mean, if you're a fiduciary and if you're really looking out for your client's best interest, this is a conversation you have to have. You have to have it because you do not want Jerry Clark to call you one day and say, I just got hit by a car in Hot Springs, Arkansas. Tell me about the disability insurance coverage I have in place. And then do the humma. It's awkward. So definitely have to have this conversation.
Sure. Well, that about brings us to the end of this session. It's about 45 minutes. We like to keep these relatively short and sweet. If any of you have follow-up questions, I'm assuming free to reach out to either one of you, Jerry Clark or Ed Sims, the insurance group. You can find them on Workplace. I want to thank you all again for tuning in. We have our next session of these coming up here in a few weeks. Would really encourage you to spread the word and hopefully tune in. We put them together for you, and hopefully this time has been productive. Again, any feedback or thoughts are encouraged. So again, thank you all for tuning in, and have a great Thanksgiving holiday.
Bye, all. Thank you.